Unfortunately, we have to talk rate hikes again. Now, while the news did make it sound like this week's rate hike was a big surprise, the market was actually going in with a 50-50 chance. And so realistically, I do think that it was less of a shock compared to some of the other rate hikes that we have seen in the past year. Although we as homeowners are definitely feeling it more if we're on variable mortgages or about to renew our mortgage. Now, it does look like the BoC has stepped out of the sidelines now, and they're sounding a lot more hawkish these days. And so we might be expecting at least another rate hike this year. So in this video, let's talk more about the lingering impacts for homeowners and also potential buyers and update our rate hike outlooks from Economists and then see how all of this will tie back into Toronto real estate going forward. Let's dive in. First off, let's see how this rate hike continues to affect mortgages. Now, for active buyers, the immediate impact might not be as severe if they did get a pre-approval locked in at lower rates. But once those expire, then purchasing power will likely decrease. And what's happening these days is that even though target rates and variable rates are going up another 25 basis points, realistically, most people are going with the lowest rates on the market, which are currently the 3-year fixed rates. From the lows of around 4.8% in March, the next 2 rate hikes are slowly being priced in, and currently fixed rates are now sitting at around 5.3%. There's actually a lesser increase in 3-year fixed rates compared to 3-year bond yields because banks are being more aggressive in offering better discounts these days to fight for business. But either way, if buyers need to refresh their rates now, purchasing power will decrease by around 5%. Let's look at existing homeowners with variable mortgages and trigger rates. By now, most variable mortgages with trigger rates will have their principal payment portion already been absorbed. And so basically, every rate hike means that monthly payments will go up if you are a variable rate holder. For a $1 million mortgage, each 25 basis points of increase is around a $200 increase in payments. And so unfortunately, it does continue to bleed for these mortgage holders. But perhaps the ones who will be toughest hits all at once are those on fixed rates who need to renew very soon. So let's say someone bought during COVID and they locked in a 2-year fixed rate at around 2.5%. Now, if they need to renew their mortgage soon at 5.3%, their mortgage payment on a $1 million loan goes from $4,000 to $5,300 per month. That's a $1,300 increase all at once. So that's got to be the most painful of them all. Now, rates seem to be going up again, and so your natural next question might be, what's next? Well, the Bank of Canada wants to see inflation hit 3% by summer, but when we look at the 3-month measures of core inflation, we're still much higher than that at 3.5% to 4%. The economy is pretty strong. We have strong GDP growth, robust labor markets, thriving housing markets, and a solid consumer spending number. Plus, the time between this and the next rate decision is actually shorter than typical. So realistically, it is hard to imagine drastic changes in just 5 weeks before the next meeting. And because of this, Scotia does predict a possible 25 basis points of rate hike again in July, depending on where data will be. RBC agrees. They added that if the 4.5% wasn't enough to cool inflation, then the 4.75% is probably not enough either. And so in other words, another rate hike is imminent. BMO shares a similar sentiment, suggesting that if the data remains firm, which is very likely, then we can expect another rate hike in July. And perhaps the most confident prediction does come from TD, who fully expects another hike in July because BoC is back in hiking mode. Rate hikes usually mean real estate prices drop, and it is going to be likely to be happening again. But this time around, we're not talking about rates going up from 0.25% to 4.25% in under a year, but possibly a 0.5% increase. And so the softening should be much less severe, and we're likely going to enter into more of a balanced market because of this, which is actually healthy for real estate. We've already started to see the real estate market start to balance out. There's more listings coming onto the market, and summer is coming, which is typically softer for real estate in general too. So what we do predict is that this new round of rate hikes is going to cut down on the FOMO mentality, and prices might end up softening around 5% because of the new rate hikes that were not previously priced in. And this much of a price fluctuation isn't actually out of the normal. More balance in the market just means that it's not going to be only a seller's market anymore, but buyers also do have a better chance these days too. Now, homeowners are feeling the pinch, and we understand your situation. Holding power continues to weaken, but the good news is that we are really much closer to the peak than before. Although rates aren't expected to come down anytime soon this year, these hikes are intended to bring inflation back down to 2% sooner rather than later. So while it will be very much a short-term pain, it should lead to long-term gain as long as you can hang on to your investment. Right now, economists do predict rates to come down by mid next year, which will start to help to balance cash flows, prices, and rents going forward more effectively. Now, if you are in the market to buy, there will definitely be great opportunities if you find the right seller. And right now, even though you might end up getting similar buying conditions with less stress, just like the summer of last year, I would argue that it is a more predictable environment with less uncertainty compared to the same time last year, as we're seeing more positive signs that inflation has been coming down because of the aggressive rate hikes last year, and we are much closer to the end of the full rate hike cycle. So basically, keep your cash ready so that you can pull the trigger at any time in case a great deal pops up. Now, we did mention Elevate Accelerators in the last video, and we are bringing it up again because signups are still open until June 16th. Elevate Accelerators is a new powerhouse community we've created where we'll share our Toronto real estate investing secrets with a small group of like-minded members, capping each meeting to 20 members. We have a fantastic lineup of topics, and you can find all the details on our Elevate Accelerators website. Just head over here to check it out and apply before our deadline on June 16th. If you're actively searching for properties, our sales team is happy to help. Just head over here to book an initial meeting with us to get started. Now, before you go, please give this video a thumbs up and subscribe to our channel. By doing so, you'll stay up to date with the latest trends, housing policies, interest rates, and investment strategies specific to Toronto real estate. Our team is committed to making real estate investing easier for you. We offer a wide range of services tailored to Toronto real estate investors. Whether you need help with planning and analysis, sales, renovations, leasing, or property management, we've got you covered. To learn more about our services we provide, simply head to our website or find us on social media. Thanks so much for watching, and we'll catch you in the next video.